Welcome to The Explainer. I am so thrilled you're tuning in today because we are going to unpack one of the absolute most fascinating shifts happening in the financial world right now. We're looking at the exact blueprint to becoming a funded trader. And get this, doing it without risking your own personal savings. We're going to break down the whole shebang, the strategies, the mindset, and the actual tangible math behind scaling up to institutional capital.
So think about this for a second. How do traders go from literally $0 of their own risk capital to suddenly managing $1 million in a funded account? I mean, 10 years ago, if you wanted to trade for a living, you basically needed either a fancy finance degree to get your foot in the door at an investment bank, or you needed a massive personal savings account. The average person simply didn't have the capital. But wow, the game has fundamentally changed. And today, we're going to show you exactly how that huge barrier has been completely shattered. Okay, let's dive into this. Here is our roadmap for today's explainer. We'll start with the prop firm revolution, then look at the 5-phase roadmap, followed by mastering the evaluation, risk and psychology, and finally, managing the funded account.
All right, kicking things off with part 1, the prop firm revolution, and how we are breaking that capital barrier.
I absolutely love this quote from 0.1% Capitals. It hits the nail right on the head. They say the prop firm model didn't lower the standard for success in trading, it lowered the capital barrier. This is so vital to understand. Proprietary trading firms, or prop firms as we usually call them, will literally give you their money to trade with. We're talking up to hundreds of thousands of dollars. And the crazy part? You get to keep up to 90% of the profits. But look, make no mistake here. They aren't just handing this capital away to anybody with a pulse. You absolutely still need strict, rule-governed, intensely risk-managed execution to succeed. The standard is as high as it's ever been.
Now, you might be wondering, how do you actually get your hands on this capital? Well, there are generally two paths you can take. First up is the traditional evaluation model. This is where you pay a pretty small upfront fee, usually somewhere between $155 to $540. And then you have to prove your skills over a month or two. You do this by hitting specific profit targets without breaching their strict drawdown limits. Then, and this is super interesting, there's the zero model, like the one offered by Funding Pips. For a slightly higher entry fee, right around $499 for a 100K account, you actually skip the evaluation phase entirely and get instant access to a live master account. It totally saves you from the pressure cooker of an evaluation, but just keep in mind, the risk management rules, they are just as strict.
Moving right along to Section 2, the 5-phase roadmap, taking you from a total beginner to a funded trader.
Okay, here are the exact 5 sequential phases you really need to follow. Phase 1 is your foundation. This means really understanding market DNA, how big institutions actually move price, and the basic mechanics of leverage. Phase 2 is technical mastery. This is where you're learning to read Japanese candlesticks, chart patterns, and your key indicators. Then we hit Phase 3, strategy deployment, where you're actually building and rigorously back-testing your system. Phase 4 is the evaluation itself. And finally, Phase 5 is funded and growth. Now listen to me carefully on this. Skipping straight to the evaluation phase without totally mastering those first 3 steps, that is quite literally the most expensive mistake a beginner can make. Don't do it.
Now, what's really interesting about this is when we apply these phases to a highly volatile asset, like gold or Bitcoin, you just can't guess. You need structure. A disciplined strategy requires at least a 3 confluence entry. What does that mean? It means you need 3 entirely separate technical reasons to even take the trade in the first place. Maybe it's a specific candlestick rejection right at a major support or liquidity zone, combined with a moving average crossover. It's like a giant puzzle coming together. And you need to backtest this specific setup across over 100 historical instances just to prove you actually have an edge in the market. Then, and only then, you absolutely must demo trade it for at least 30 sessions under strict prop firm rules before you ever hand over your hard-earned money for a real evaluation.
All right, part 3, mastering the evaluation and actually passing the challenge.
80%. Let that sink in for a second. That is the massive, frankly staggering failure rate for self-taught traders attempting these prop firm evaluations. Why on earth is it so high? Because people come in and treat the market like a casino slot machine instead of a real business. They jump straight into a challenge without doing those 30 demo sessions we just talked about. They pull the lever on a massive, hopeful trade, and boom, they get completely wiped out. Let's look at the actual math and the rules you have to beat in a standard evaluation from firms like FTMO or the Fivers. Usually, you need to hit a 10% profit target. But here is the catch, and it's a big one. You have a daily drawdown limit of just 5%. That means if your account drops by 5% in a single day, you lose the account instantly. Poof, gone. So, how do you survive this? Professional traders use a super strict risk per trade of just 1%, aiming for a realistic daily goal of about 0.5% to 1%. It is 100% a test of your risk management, not a sprint to get rich quick.
It really boils down to this. Small, consistent gains are what actually pass challenges. Aggressive, risky trades blow accounts and just lose you your valuation fees. If you go in trying to hit that 10% target in just 2 days by risking 3% per trade on a crazy volatile Bitcoin or gold swing, honestly, you are just gambling at that point. One bad spike against you and you've breached that 5% daily loss limit and you can kiss your $155 to $540 valuation fee goodbye for sure.
Which brings us nicely to Section 4, Risk and Psychology, otherwise known as the mental game.
You know, disciplined trading is actually kind of boring. And honestly, that's a very good thing. It means you're sticking strictly to a 2% daily stop. If you lose 2% today, you literally just close the laptop and walk away. Go for a walk. Emotional trading is the exact opposite of that. It's frantically changing your strategy right in the middle of an evaluation just because you took 2 losses. Or it's jumping into random trades because you feel the ticking clock of the evaluation timeline breathing down your neck. Discipline under pressure is literally the only thing that separates the funded 20% from the 80% who fail.
Let's get super specific about the mistakes that will absolutely kill your trading aspirations. Attempting the evaluation without demo prep? Yeah, we've covered that one. Changing your strategy after early losses? This is huge. Look, if your sample size is only 3 trades, your strategy hasn't failed. Variance is just happening. That's just statistics. Treating the 10% target as a sprint will inevitably get you liquidated. And finally, trading without a journal. Keeping a simple 5-minute daily journal allows you to actually spot your own toxic habits on paper and fix them before they cost you money.
And hey, if you don't journal, you'll almost definitely fall victim to this monster: revenge trading. This is that overwhelming emotional urge to immediately win back your lost capital by executing aggressive, totally off-strategy trades. It is a massive psychological trap. Picture this. You take a totally normal, managed loss on gold. But you get angry, so you double your lot size on the very next trade just to make it back. Well, suddenly, the market moves against you again, and you've just breached your daily drawdown limit. Game over.
All right, let's head into our final section, Part 5, Managing the Funded Account, Scaling Up and Utilizing Multi-Accounts. And this brilliantly illustrates why this is such an incredibly lucrative career path when done right. Let's do the math, because the numbers add up really fast. At a very conservative 5% monthly return and keeping an 80% split of the profits, look at this. On a starter 10K account, that's $400 a month. Hey, not bad for a side hustle, right? But take your professional 100K account. That exact same boring conservative 5% return now nets you $4,000 a month in pure profit. And remember, you haven't risked your own life savings to get those returns, just that initial evaluation fee.
But wait, the truly elite traders, they take this to a whole other level with the multi-account strategy. There is absolutely no rule out there saying you can only trade for one firm at a time. Professional traders will pass evaluations at FTMO, the Fivers, and Blueberry, all at the same time. How? They use trade copying software to execute their exact same low-risk strategies simultaneously across all 3 accounts. So suddenly, you're managing $300,000 in capital, generating 3 times the income, and you haven't increased your screen time by a single minute. It's wild.
It really is an incredible ecosystem, provided you actually respect the rules and put in that structured preparation we talked about today. So I want to leave you with this question. Are you currently trying to get funded right now, or are you planning to start your prop firm journey soon? Let that sink in. Think really honestly about which phase of the roadmap you are genuinely in at this moment. Don't rush it. Remember, protect your capital, respect that daily drawdown, and always trust the process. Thanks so much for joining me on this explainer, and I'll see you all next time.